The American economy isn't a smooth ride. From the earliest days of the Republic, economic crises have brought financial panic, bank failures, unemployment, and suffering. Booms turn to busts, bubbles pop, and ordinary people lose savings, jobs, and homes. What most people don't realize is that these crises follow a pattern, repeating throughout American history with eerie consistency. By the end, you'll see that the crises aren't random accidents, but the inevitable result of speculation, easy credit, and the belief that this time is different. Panic of 1792, America's first financial crisis. Just 3 years after the Constitution was ratified, America experienced its first financial crisis. Speculation in bank stocks created a bubble as investors borrowed heavily to buy more shares, convinced that prices would continue rising forever. When speculators couldn't cover their loans, prices crashed by 25% in 2 weeks. Alexander Hamilton intervened by having the Treasury purchase government securities to inject liquidity, essentially inventing the government bailout. The crisis established patterns that would repeat: speculation fueled by borrowed money, overleveraging, panic selling, and government intervention. Panic of 1837. Jackson's legacy. Andrew Jackson's war against the Second Bank of the United States set the stage for disaster. Jackson withdrew federal deposits and distributed them to state pet banks, which issued excessive credit. Speculation in Western lands exploded. When Jackson required land purchases in gold or silver rather than paper money, the bubble burst. Banks failed by the hundreds. The Depression lasted until 1843. The panic demonstrated that destroying financial regulation without replacement created massive instability. Panic of 1873. The Long Depression. The failure of Jay Cooke and Company triggered a crisis lasting over 5 years. Railroad overbuilding had created massive overcapacity. The New York Stock Exchange closed for 10 days. Over 18,000 businesses failed. Unemployment reached 14%. Wage cuts sparked violent labor conflicts, including the Great Railroad Strike of 1877. The Long Depression demonstrated that economic crises could be prolonged and devastating, not just short panics. Panic of 1907. The run on banks. A failed attempt to corner the copper market triggered a cascade of bank runs. With no central bank, J.P. Morgan personally organized a rescue, summoning bank presidents to his library and forcing them to provide liquidity to failing institutions. Morgan essentially functioned as a private central bank. The crisis demonstrated that the economy couldn't rely on one man's goodwill. The 1907 panic directly led to the creation of the Federal Reserve System in 1913. Great Depression. The Great Depression was the worst economic catastrophe in American history. The stock market crashed in October 1929. Banks failed by the thousands as panicked depositors withdrew savings. By 1933, unemployment reached 25%, and GDP had fallen by nearly 30%. Thousands of families lost homes and farms. President Hoover's limited intervention failed. Franklin Roosevelt's New Deal introduced massive government programs, including Social Security, the FDIC to ensure deposits, the SEC to regulate markets, and public works programs employing millions. The Depression didn't fully end until World War II. Military spending created full employment. The lessons included that government must act as lender and spender of last resort, that deposit insurance prevents bank runs, and that unregulated financial markets can destroy economies. 1970s stagflation. The 1970s brought simultaneous high inflation and high unemployment, called stagflation, which economists thought impossible. The 1973 Arab oil embargo quadrupled oil prices. The 1979 Iranian Revolution caused a second oil shock. Government spending on Vietnam and Great Society programs without corresponding taxes had already created inflationary pressure. Unemployment and inflation both exceeded 10%. President Carter appointed Paul Volcker as Federal Reserve Chairman in 1979. Volcker raised interest rates to over 20%, deliberately inducing a recession to break inflation. It worked, but caused severe pain and contributed to Carter's defeat in 1980. 1987, stock market crash. Black Monday. On October 19, 1987, the stock market fell 22.6% in a single day, the largest one-day decline in history. Program trading created a cascade of selling. Unlike 1929, the Federal Reserve under Alan Greenspan immediately announced it would provide liquidity, preventing banking panic. The economy continued growing. Black Monday demonstrated that stock market crashes didn't necessarily cause depressions if the central bank responded appropriately. Dot-com bubble. The rise of the internet created irrational exuberance about technology stocks. Companies with no profits achieved billion-dollar valuations. The Nasdaq rose from under 1,000 in 1995 to over 5,000 in March 2000. When the bubble burst, the Nasdaq fell 78%. The recession was relatively mild, with the Federal Reserve cutting interest rates aggressively. However, the low interest rates fueled a new bubble in housing. 2008. Financial crisis, the Great Recession. The 2008 crisis was the worst since the Great Depression. Banks issued trillions in subprime mortgages to borrowers who couldn't afford them, then packaged these into complex securities rated as safe. When housing prices fell, borrowers defaulted, securities became worthless, and banks faced insolvency. In September 2008, Lehman Brothers collapsed. Credit markets froze. AIG required a $182 billion bailout. The stock market lost 50% of its value. Unemployment reached 10%. The government responded with the $700 billion TARP bailout, Federal Reserve lending facilities, auto industry bailouts, and stimulus spending. Nearly 10 million Americans lost their homes to foreclosure, and the crisis demonstrated that financial innovation had outpaced regulation, that too-big-to-fail institutions create systemic risk, and that the costs fall disproportionately on ordinary people, while bankers faced few consequences. The crisis fueled political populism on both left and right, and reshaped American politics and trust in institutions. COVID-19. Pandemic economic crisis. The COVID-19 pandemic caused the sharpest economic contraction in American history. When lockdowns began in early 2020, 22 million jobs were lost in March and April, the fastest job losses ever recorded. Unemployment spiked from 3.5% to 14.7% in a single month. GDP contracted at an annualized rate of 31.4% in the second quarter. Unlike previous crises, this was caused by a deliberate shutdown to protect public health. The government response was massive. The CARES Act provided $2.2 trillion, including direct payments, expanded unemployment benefits, and the Paycheck Protection Program. The Federal Reserve cut interest rates to zero and bought unlimited quantities of securities. On total pandemic relief exceeded $5 trillion. The combination of massive support and vaccine development led to rapid recovery. By late 2021, unemployment had fallen to 4%. However, the pandemic fundamentally changed the economy with permanent remote work, accelerated e-commerce, and disrupted supply chains. Inflation crisis. The massive pandemic stimulus combined with supply chain disruptions and pent-up demand created the worst inflation in 40 years. By June 2022, inflation reached 9.1%. Russia's invasion of Ukraine worsened inflation by disrupting global energy and food supplies. Gas prices exceeded $5 per gallon. Grocery prices rose over 10%. The Federal Reserve responded with the most aggressive rate increases since the 1980s, raising rates from near zero to over 5% in less than 2 years. Mortgage rates went from around 3% to over 7%. The stock market declined significantly in 2022. Economists predicted recession, but unemployment remained low even as inflation declined to around 3%, suggesting the Federal Reserve achieved a soft landing. Tariff crisis. As of 2025, the American economy faces unprecedented challenges as the Trump administration implements the most aggressive tariff policies in nearly a century. After his re-election, Trump moved quickly to impose 25% tariffs on Mexico and Canada, 10% on China, and reciprocal tariffs on dozens of countries. In January 2025, the average U.S. tariff rate was 2.4%. By April, it had jumped to 27%, the highest in over a century. Job growth collapsed to only 584,000 jobs added in all of 2025, compared to over 2 million in 2024. Corporate bankruptcies hit levels not seen since 2010. Consumer confidence plummeted. Courts ruled some tariffs illegal, with cases reaching the Supreme Court. The stock market crashed in April, recovering only after delays and exemptions. By November, the effective rate had fallen to 16.8%, still 7 times higher than a year earlier. The paradox is that despite this disruption, GDP grew 4.4% in the third quarter of 2025, the strongest growth in 2 years, and unemployment remained around 4%. Investment in artificial intelligence played a major role. However, economists warn the damage is slow burning, and the full impact won't be felt for years. Lessons. Looking across 200 years, certain patterns emerge. Financial panics follow periods of speculation and easy credit when investors believe prices will always rise. Leverage amplifies both gains and losses. Banking crises turn downturns into depressions when credit freezes. Government responses have evolved from letting crises run their course in the 19th century to massive interventions today. The Federal Reserve, created in 1913, provides emergency lending. The New Deal established deposit insurance and regulation. Post-2008 tools include quantitative easing and trillions in stimulus. These tools don't prevent crises but can shorten them. However, interventions create moral hazard when risk takers expect bailouts. Too big to fail remains a problem. Each crisis leads to reforms, but financial innovation eventually finds ways around them. The human costs are immense: lost jobs, homes, savings, shattered dreams, damaged health. The 2008 crisis increased deaths of despair. Recessions scar those entering the job market for decades. The American economy is remarkably resilient, recovering from every crisis and growing larger. But growth isn't evenly distributed, and crises often accelerate inequality. From the Panic of 1819 to the tariff crisis of 2025, American economic history has been marked by recurring booms and busts. The early panics taught that nations need central banks and stable currency. The Great Depression taught that government must act aggressively. Stagflation taught there are limits to government's ability. The 2008 crisis taught that innovation can create systemic risks. The COVID crisis taught that unprecedented challenges require unprecedented responses. Each generation faces new challenges and must learn from history. The fundamental tensions remain: growth versus stability, innovation versus regulation, individual freedom versus collective security. The pattern is clear. Speculation creates bubbles. Bubbles pop. Panic spreads. Government intervenes. Regulations pass. Time passes. Memories fade.